Hello everyone and welcome to my channel. My name is Brian Cole, the founder of EVNTAlpha, and I have over 4 years of experience working with quantitative trading systems at the largest financial data company in the world. I aim to share that knowledge I have gained with you today to help you make better decisions in the market. Today we're going to talk about important economic data prints, where the S&P might go, as well as 4 captivating trading signals you'll definitely want to pay attention to this week. With a lot to cover today, let's get right into the video. So the first thing I want to talk about is we have incredibly important economic prints coming up this week. First being the first estimate of GDP growth rate for the third quarter of 2025. This is to be released at 8:30 a.m. with a current consensus of around 3.2%. Now GDP is going to represent the total value of all goods and services produced within the U.S. So it acts as a key indicator of the nation's economic health, size, and growth. And over the course of each quarter, we have 3 monthly estimates, each getting more accurate as to the performance of the quarter. And we're about to get our first glimpse into how GDP is shaping out for quarter 3. And it's going to be our least accurate of the 3 we'll see for this quarter. When looking at the past 6 quarters, we can see leading into 2025, our growth gradually slowed and then declined in quarter 1 of 2025. We had our last report of 3.8 for quarter 2 on September 29th, showing signs of some strength returning in consumer spending, which ultimately boosted S&P levels to all-time highs at the time. A strong print this time around could ultimately do the same, especially with where you see S&P has ended up in our price action in the next portion of this video. A stronger growth than estimated would be a great bullish catalyst for the market, as it would slightly ease many investors' concerns around our economic health going into 2026. However, bear in mind, a reported growth lower than 3.8% would still be lower than the prior quarter-over-quarter GDP growth rate, and an interpretation from investors of a slowdown in consumer spending. So while a beat in GDP may be bullish in the short term initially, amidst the bigger picture, it could cause sell-offs and a signal that economic roadblocks may be ahead, if not closer in line with that prior 3.8%, and especially if it's lower than 3.2%. The next economic print I want to talk about is core PCE prices quarter over quarter, which is also coming out at 8:30 a.m. on Tuesday, with a consensus of about 2.9%. Now, core PCE is a measurement of inflation excluding food and energy, making for a less volatile trend of inflation that provides deeper insight on economic shifts in consumer spending. Now, be careful on Tuesday, as if we print a core PCE of 2.9% or higher, this could definitely stir up some controversy. When looking at core PCE since 2020, we can see the severe inflation we experienced in 2022 onset by the global economic slowdown from COVID. Since then, CPE quarter-over-quarter levels have slowly declined. In recent times, we began to see an uptick again leading into 2025, peaking at 3.3% this year. Should our Q3 estimates start creeping back to that 3.3% level as we get revisions over the next 3 months, this could definitely send a second shockwave of fear into investors, especially given the Fed has expressed continued concerns around inflation still being above target. A continued uptick would give the Fed less room to cut rates to counter our slower labor market, and in return reduce expectations of more than one rate cut in 2026, which many investors are anticipating we actually see more than one cut in 2026. So ultimately that could lead for more bearish momentum. Now, taking a look at S&P Price Action, we can see last week we did bounce off that 50% retracement level that we had discussed. We had favorable CPI data that was released, ultimately, which was a bullish catalyst for the reversal. And we went on to break back above our 38.2 and 23.6 retracement levels. Now, this could be a great bullish sign, as we technically did not fully break this trend line that we broke back in November, 28th of November. And now what we want to look to see is the price continue to trade to the upper range of this parallel channel and ultimately break. Now, it'll be really important to pay attention this Tuesday, as I mentioned before, we are going to have our release on GDP and core CPE. Now, if we do have great prints, this could definitely be a bullish catalyst to bring us back up to the top of this trend channel and ultimately break through it to create new all-time highs, if not meet the all-time high after the break. Now, last thing I want to pay attention to is we are back at the top of this trend line. Last video and the prior videos before, we had discussed RSI trading within this parallel channel. We had 2 attempts to break, in which both times it failed, leading us to create the top resistance points of our trend channel. And ultimately, we are trying to break it again. We want to see a continued sustained break. And ultimately, with this new trend line that we formed with those 2 prior failed breaks, we also want to see a break through that trend line as well. This could be a good resistance zone to pay attention to, as should we break through it, that could be a tremendously bullish sign, especially paired with favorable economic prints. Now on the downside, should we reject this resistance zone and come back down, chances are we go on to read an oversold level, as we've gradually been declining in RSI lows. And so what we really want to see is, again, that continued break. And if not, we want to see it continue to hold this support level we discussed last video. And ultimately, if not, we're probably going to see prices lower than that 50% retracement level, and ultimately see an oversold reading maybe around the 61 or 78.6% retracement levels. First stock I'm going to talk about is Adobe. They fall within the information technology sector. They're a software company that enables digital content creation, editing, publishing, and management. They developed the softwares Photoshop and Adobe Premiere Pro that many know and extensively use today. Adobe has shifted largely to a subscription-based software model, which has become a key part of the recurring revenue strategy. With that being said, the stock's trends tend to be tied to trends in digital content creation, its cloud subscription revenues, and innovation adoption, particularly with AI. Now, looking at Adobe has dropped more than 20% this year for various reasons, one being slower growth than investors expected, in which while revenue and earnings have continued to grow, it has slowed compared to previous years. Another reason is intensifying competition in AI. While Adobe has released Firefly and Agentic AI, which provides some helpful AI integration to workflow, large tech firms like Google, Meta, Microsoft, and OpenAI offer powerful generative AI tools with massive training data and infrastructure advantages, posing a significant risk to Adobe. They will have to prove to investors that they're able to adapt this new AI environment and capitalize on monetization of AI. Lastly, there has just in general been a sector-wide weakness in software stocks over the past 2 months, and this has led to valuation compression, a common theme we've seen across the board for subscription-based revenue models in the software and technology sector. To explain a bit further, Adobe has historically traded at very high valuation multiples because of anticipated strong future growth. However, as this company has matured and growth expectations have moderated, the market has also reduced those anticipated valuations. So far, these companies have not shown a strong enough translation to monetary gain to justify the vast spending we have seen in AI development, dampening growth expectations for 2026. Despite the challenges ahead, Adobe is still a massive company with a strong recurring user base, generating $23 billion as of last annual revenue reporting. Their flagship software still have strong market share and are heavily incorporated in many individuals' and businesses' workflows. You may have heard this before, but oftentimes the best time to buy a stock is when the fear around it is the greatest, as that is when price is most discounted and value presents itself. Now, here on the screen, I have a strategy called trading range that works to identify the minimum and maximum price of a stock's trading range over a time frame, and when a break in the direction towards the top of the range from the bottom is likely to occur. Here you can see when the price's moving average crosses above the yellow line, the strategy triggers, in which we've seen 11 triggers over the past 10 years. We recently had a trigger for Adobe on December 19th at a price of about $355.86 a share. Now, whenever these crosses occurred, Adobe experienced an average gain of 18.3% over the next 94 trading days. And when looking at the 94th day, the price was higher 64% of the time, or 7 out of the 11 times. When looking over the next 58 trading days, the price was on average 10.7% higher at a win rate of about 73%, or 8 out of those 11 times. The strategy is performing at a 2.5 profit factor, meaning on average, wins were 2.5 times larger than losses, requiring a 28% win rate to break even if it were to continue to perform at that rate. Taking a closer look at the performance of the triggers, on the x-axis we have trading days out from day 0 being the trigger date, and on the y-axis we have the cumulative percent change across that time frame. In other words, what we're seeing here is what would your returns be if you had bought Adobe on the day of the trigger and held for 100 trading days, or roughly 5 months out. In blue, we can see the average performance across all triggers, which you can see lead up to the 10.7% and 18.3% on day 58 and 94 respectively. And when looking at the first 20 days, we saw drawdowns as much as 11%, and in some circumstances recovering to go positive afterwards. Taking a closer look at Adobe's price action, I went ahead and marked some important support and resistance lines to pay attention to. The first thing I want to bring your attention to is this enormous triangle that Adobe has been trading within. As you can see, we have 3 contact points of support and 2 contact points of resistance. Now, ultimately, whenever triangles break, the direction it breaks in tends to be vigorous and a sign of further momentum in that direction. All right, so if we were to see it break below the support line, that could be a very bad sign for the bulls and great sign for the bears. And conversely, if we see a break above, that's a great sign for the bulls. Now, over the course of March of 2020 to roughly, August of 2022, September 2022, we experienced a series of bullish divergences that bounce along this trend line we developed. As you can see, we had higher lows in price between March of 2020 and March of 2021, but lower RSI lows. In March of 2021 to roughly October 2021, we had higher lows, right? But lower lows in RSI. And conversely, when we went on to test that trend line again, as you can see from the March of 2020 to roughly September of 2022, we also experienced some bullish divergence, which led us on to create the top of our triangle, creating a trend line to definitely pay attention to in the future. Now, taking a closer look at the past year, we had 2 instances of bullish divergence that were significant, right? One, December 2024 leading into 2025 to April 2025, where we experienced higher lows in RSI but lower lows in price, and went on to create our trend line that we recently broke in December of 2025, onset by the bullish divergence we experienced between July and November. So now from here, ultimately, whenever you have trendline breaks, it's a great sign that you're going to go on to retest some of the swing highs that it created along the way. And the first one being around $371 a share. So if we do see price break above our 200-day MA in that 371 resistance trend line, ultimately that leads us to our next target of our resistance zone between $406 and $422 a share, and closer in line with that 18.3% average return we tend to see from this trigger in trading range. On the downside, I marked roughly about a 6% stop loss to respect a 3-to-1 ratio. Ultimately, that falls really close in line with this trend line. So say we do reject off the 200-day MA and this resistance point at 371, maybe we go on to retest a trend line and bounce off further, or ultimately breaks through the trend line and goes on to retest the bottom of our triangle again. So the next ticker I want to talk about is PGR, also known as Progressive Corporation. They fall within the financial sector, and they are one of the largest auto insurers in the United States, providing a broad range of insurance products and services such as personal auto insurance and commercial auto and business insurance. Down almost 25% since its all-time high in April, Progressive has had some disappointing quarterly results recently in which they missed earnings expectations in its most recent report, suggesting challenges in maintaining profitability and matching high growth expectations. Progressive's combined ratio, a key insurance profitability metric, deteriorated in part to 2025, showing a sign of margin pressure as it indicates that claims and underwriting costs were rising faster than premiums collected. In addition, Progressive had to take a large charge tied to profit caps in Florida, which reduced net income and drove fear in investors, even though this was a one-time adjustment. With the poor financial performance we've seen over the past year, that leads them to $224.28 share currently. Ultimately, we'll have to see a turnaround in financial performance to see better stock performance in the future. Now, what could be a bullish catalyst for PGR in the near future? Well, for one, given Progressive's business model thrives off Having higher income from insurance premiums than costs from insurance claims, a major uptick in insurance premiums from increase in drivers insured would be a potential source. When looking at U.S. automobile sales, we recently saw an uptick this past quarter after a consecutive three-quarter decline, showing signs of strength potentially returning in the automobile industry and reaching levels closer to quarter four of 2024 and pre-COVID levels in the near future. Also notice that automobile sales over the past 5 years, especially post-COVID, tend to be strong leading into the fourth quarter, likely due to Christmas, as what better time to give someone or yourself a new car. An uptick in new cars means an uptick in insurance coverage needed, hence an increase in potential customers for Progressive. This could be a potential source to that uptick in insurance premiums PGR would need. In addition, over the past 3 years, we saw an increase in new drivers in the U.S. ranging from 1.8 million to 2.8 million a year, with the projected number to be roughly 249 million in 2028, an average increase of 2.5 million over the next 4 years, including 2025. If Progressive is able to grasp a respectable share of this projected increase, this could be great in increasing their income earned from premiums and potentially easing pressures in margins from insurance claims should they be able to remain competitive in pricing while doing so. Honing in on PGR in relation to that uptick in automobile sales we tend to see in Q4, here I have the last day of every December marked with a green dot. While it wouldn't be correct to say the uptick in automobile sales in Q4s is 100% the reason for the historical performance I'm about to highlight, what we can say is there is a commonality between the two. When looking at the top row, we can see that when looking over the next 200 trading days out from the start of January, PGR rose on average 23.41%, in which 80% of the time the price was higher looking out from the New Year's start. When looking 75 trading days out from the start of January, the price rose 12.56% on average, in which 100% of the time the price was higher. When taking a closer look at reactions, we have 2024's trigger highlighted in orange, indicating it's the most recent trigger. 50 and 100 trading days out from the most recent trigger in December of 2024, the price reached roughly 20%. Looking at the blue line representing the average performance of triggers, we can see it lead up to that 12.56% and 23.41% on the 75th and 200th day, respectively. From what we know is historically Q1 of each calendar year tends to be great for PGR, so maybe at the start of January we see a boost in performance in anticipation of increase in premiums. Next, I wanted to show you an RSI trigger from PGR, which triggered back on November 4th of this year. As you can see, anytime RSI dips below 15% and cross back above, it's marked with a green dot in the price in the top panel. We've seen 7 triggers like this over the past 10 years, in which on average the price rose 21% over the next 96 days. Currently, this trigger is on the 32nd day, in which it's currently up 7%, highlighting still a potential 14% average gain over the remainder of the 96-day duration. Looking at reactions closer, we can see in orange the current trigger leading up to that 32nd day and where it compares to the average performance in blue over the next 100 trading days. Currently, we're seeing performance in line with the average performance. However, there is no guarantee we will continue to see performance in line with the average. It's more so a useful reference point to see what is realistically possible based off history. Another strategy that recently triggered for PGR was MACD. MACD measures the spread between two moving averages to understand when momentum is shifting, in which when the white line crosses above the red line, this indicates bullish momentum, and vice versa would mean bearish momentum. I personally use a spread based on percentage difference rather than net difference to have a more proportional measurement of spread over time. Here we can see that whenever a MACD cross occurred and the short-term moving average was less than 5% above its long-term moving average, PGR rose on average 14.7% over the next 99 trading days. We've seen 10 crosses in the last 10 years in which 90% of the time, or 9 out of the 10 times, the price was higher in the 99th day. Notice the incredibly large profit factor, as the one loss we had was only 0.1% on the 99th day, meaning historically we've seen a tremendously large upside relative to downside risk. When taking a closer look at reactions, we can see that blue line representing the average performance leading up to that 14.7%. In addition, notice some of the most extreme drawdowns we've recorded from the trigger price is about 10 to 12% throughout those 99 days. However, historical reactions went on to recover to break even or better leading into the 99th day. So lastly, we saw a trigger for trading range for PGR on December 15th last week. Currently, it's on day 4 of the trigger, down 5%. Historically, what we've seen is 92 days out from the trigger, the price rose on average 22.2%, in which on all 4 historical times, the price was higher. When taking a closer look at the performance of the triggers, in yellow we can see the current trigger live, in which notice that we are currently experiencing a drawdown very close in line with prior occurrences, where price began to rebound. Historically, by the 10th day, all 4 triggers were in the money and rose to an average of 6% above the trigger price on the 16th day, or about 3 calendar weeks out. This is not to say it is guaranteed that this time around we will see a bounce like historically from that down 5% point, but to say based on history, we know it's more likely than not that we see a bounce when looking at price relative to this measurement. Looking at the average performance in blue, we can see that 22.2% reached on the 92nd day. Taking a look at PGR's price action, I've highlighted some important support and resistance points to pay attention to should you be following PGR. So the first thing I want to highlight is RSI has been trading within a parallel channel in which the bearish and bullish divergence that we initially experienced set the shape of our parallel channel, in which you can see we had higher lows in price but lower lows in RSI, and then ultimately higher prices or higher highs in prices but lower highs in RSI. This bearish divergence ultimately went on to exhaust to retest the support of our new realized parallel channel, in which you can see we bounced off around 202.38 a share. This fell very closely in line with lows that held as support in April 2024 to June of 2024. In addition, notice that when RSI came down, it came very close in level with this low we realized back in July of 2023. So we had a bit of a confluence in RSI support between these 2 points, ultimately creating our support trend line now that we've realized this low back in November 3rd of this year. Taking a closer look at the current scene, we recently had a gap down on October 13th, in which we went on to actually fill it recently, December 16th. Ultimately, we see we've been developing a trend line here in which we finally broke and went on to retest this resistance zone that was one support, and now we are retesting this trend line that we broke, as well as retesting the trend line in RSI that we recently broke. From here, what we were going to want to see is a bounce off this trend line or a sustained support along this trend line, maybe a reinvigorated reversal in price off this support now that we've created it, to ultimately lead to a breakout of this resistance zone. Now, I also went ahead and plotted what the percent changes would look like based off the various triggers. So first, with RSI, with the average gain of 21% that triggered back in November 5th. As you can see, that would bring it to a price around 255.22 a share. On the downside, it marked a risk of about 7.3%, or roughly 194.19 a share. Ultimately, this long-term support line, as well as the support at 202.38, will be great reference points alongside the stop loss should we see price begin to pull back down. Like I said before, we want to continue to see a sustained price above this trend line and ultimately go on to retest this resistance zone again. Ultimately to go on to try and break it. All right. In the remainder of the 96 days, we still have a 14% potential based off of average performance. And so ultimately, if we do see a hold here and a bounce to break, chances are we are going to see that average performance reached. When looking at that trading range trigger, we saw an average return of 22.2% leading out to that 90-second day. That would put us out around March 26th and a price upward of $289.05 a share. On the downside risk, I have 7.3% plotted out, or 218.94%. So as you can see, we're currently down about 5% from that trigger price. Historically speaking, we haven't seen drawdowns much lower. However, that doesn't mean, this time around we won't continue to drop. Lastly, with our most recent trigger, with MACD, we have plotted out an average return of 14.7% roughly, falling very close in line with the RSI trigger, which also noted we have about 14% return potential as well. So that would bring us to about 257.22 a share. And on the downside risk, we have about 4.8% plotted out, which is about a stop loss of 213.33. So very close in line with the support that we realized back in November. So that is everything today. I really hope you enjoyed the video. If you did, please like and subscribe. Maybe comment down below what you thought about the triggers, or if there's any other interesting tickers you've been looking at. And I hope you have a great rest of your day or night.